When you sell something, the resulting gain can be treated as either ordinary or capital. So it's important to know the benefits of a capital gain and what exactly makes it a capital gain or loss. First, capital gains are a great tool for individuals to lower their tax liability. Why? Well, I'm glad you asked. That's because capital gains, specifically long-term, have a preferential tax rate. It's either 0%, 15%, or a maximum of 20% depending on your taxable income. And compare that to the maximum marginal tax rate of 37%. First things first, what is long-term? Easy. It refers to a holding period of longer than 1 year. Say you have a capital asset that you hold for longer than 1 year, then you sell it, realize a gain, and then that gain is treated and taxed at the preferential tax rates I've just listed. And say you have the same capital asset, you hold it for less than a year, you sell it, realize the same gain, it will be taxed at your marginal tax rate. So short-term capital gains are not beneficial. Now, what is capital property? I'm not going to give you a technical definition because the regulations, and feel free to read them if you want, it's section 1221. Those regulations don't provide an actual definition, rather a list of things that are not capital assets. And if I were to do that right now, this video would be unwatchable, too long and too boring. So in layman terms, capital assets include stocks, bonds, digital assets such as cryptocurrencies and NFTs, collectibles, though the latter have different tax rates and different rules outside the scope of this video. If you own and live in a house, that is considered to be capital asset, though the sale of the house has different rules, and I will create a separate video dedicated specifically on the sale of your house. Also, capital assets could be gas, oil, and mineral rights. There is a lot of discussion on whether contract rights are capital assets. Well, technically, contract rights are property interests, though some can be considered capital assets. Personal use property are capital assets, but with slightly different rules. If you sell personal property at a gain, that gain is treated as capital gain. However, if you have a loss on sale of personal use asset, that is not deductible at all. Things that are not capital assets include business assets, real property or depreciable assets, or assets that are used in production of income are not capital assets, and inventory is also not a capital asset. Section 197 intangibles, which include goodwill, patents, copyrights, know-hows, designs, formulas, franchises, trademarks, trade names, and similar, are not capital assets. Also, letters and memoranda, for example, if you have drafts of speeches or manuscripts or drawings and photographs, those are not capital assets. Now that we're confident with these basics, I just want to point out the scope of this video, which is the taxation of capital gains for individuals. For corporations are taxed at the corporate income tax rate. Well, okay, I'll briefly discuss the taxation of corporations when it comes to capital gains and losses. And there are some stark differences. So capital losses can only be used to offset capital gains for corporations, which is slightly different from individuals. And if the corporation ends up with more capital losses, it can carry those back 3 years or forward 5 years. And unused capital losses are lost forever and become non-deductible, which is quite different from what individuals have. For individuals, capital losses are also used only to offset capital gains, plus $3,000 of ordinary income, such as income from your salary, self-employed income, or other investments, etc. And if you married but file separately, then this amount goes down to $1,500. And if you have more capital losses, you cannot carry them back like corporations can, but you can carry them forward indefinitely. However, please also keep in mind that there are special rules for wash sales. For example, you sell an investment at a loss, and then within 30 days you purchase a substantially similar or identical investment. That initial loss is disallowed. The taxation of capital gains and losses has been a point of debate and discussion for a long time. Some see the preferential tax treatment as an unfair advantage for the wealthy, and some see them as perfectly fair. It is beneficial for the economy to incentivize investment into capital assets, and we all know that the financial markets are a big part of the health of the US economy. So it makes sense to promote the trade of stocks and bonds and other capital assets I've just discussed. And one way to do that is through preferential tax treatment. In addition, if you're an individual and decide to purchase stock of a company, become the so-called investor, you're going to use your after-tax money to make the purchase. For example, once you get your wages, salary, income from your self-employment or other investment, you're going to be taxed on all of that income, and only the leftover will be available to you to make the purchase of a stock of another company. And imagine once you sell the appreciated capital asset, you're being double taxed on that same money using the same ordinary marginal tax rates. If that were the case, there would be less purpose to invest, or the required return on investment would probably be a little higher, just because the big portion of a capital gain would be wiped out by the higher marginal tax rates if that were the case. And the same logic goes for qualified dividends, because they are taxed at the preferential rates as well. Now, how can you utilize capital gains for your benefit? Well, this video is already getting kind of long, so I'm not going to go over a crazy example. I'll just go over a simple example and show you what difference can capital gains make in terms of your tax liability. We'll look at an example of when you have capital gains versus you don't have capital gains. And spoiler alert, those capital gains will be taxed at 0%. So the difference in the tax liability will be $1,200. So it may be worth watching through. Now, before I go on, let me just quickly point out that if you take advantage of tax-deferred pension plans and you trade stocks and bonds within your 401k or IRA accounts, those realized gains or losses do not trigger any tax for you. Those earnings are only become taxable once you take the distributions once you're on pension. So now let's go over an actual example, and I'll be using my notes here, so I hope you don't mind. I'm pretty sure all of you or many of you have seen a brokerage statement, specifically forms 1099. There are 1099 forms for interest, for dividends, and there are also consolidated forms 1099 that show you everything, including your capital gains and losses, as well as classification for those gains and losses as short-term versus long-term. I have a married couple which in total had a net short-term gain of $4,100 and a net long-term gain of almost $10,000. And so the net gain short-term plus long-term is $14,074. So before we go on, let me quickly show you the actual capital gain tax rates, the preferential rates that I listed in the beginning of this video. Remember how I said capital gains are taxed at either 0%, 15%, or 20% depending on the income. It also depends on the filing status, so you will see a quick table in here. Jack and Jane Davis for 2022 made $90,000 in wages, and then they also had the above stated capital gain of $14,074. So their total income is $104,074. And the standard deduction, let's say they don't itemize, the standard deduction for married filing jointly for 2022 is $27,300, which makes their taxable income $76,774. And because they do have capital gains and losses and they receive this 1099 form, there are certain filing requirements on their personal individual taxes, specifically the Schedule D, capital gains and losses. Part 1 specifies short-term capital gains and losses, and Part 2 specifies long-term, and we know they had both types. In addition to that form, there is Form 8949 that needs to be filled out with more details. And when it comes to the actual tax on 76,774 taxable income, the tax liability for the family is 7,602, which makes your effective tax rate only 10%. Let's compare that to the same case scenario, except there are no capital gains at all. Let's see what the tax liability would be. Spoiler alert, it would be higher. So W2 wages on line 1 is 104,074. Remember that their gross income in the previous example was exactly the same amount. So there are no capital gains or losses, no Schedule D to be attached, no 8949 form to be attached, a very easy tax return. The same standard deduction for 2022 merit filing jointly is 27,300. The same taxable income of 76,774, the magic number, right? And all of a sudden you see this tax liability being 8,802, higher than the previous example. And so in this case, the effective tax rate is 11%. This couple in two different examples made the same amount of income, except the income classification was different. In the first case scenario, there was capital gain, long-term specifically, and in another case, there was no long-term capital gain. Remember how sometimes people ask, why do I make the same amount as my neighbor, yet we pay very different tax amounts? Well, that's why the classification of income matters. I hope this information was useful to you, and I hope to see you in the next video.